Hey there, Brian Bogner here, along with our very knowledgeable and expert CIO, Mr. Gregory Towner. We're going to be talking to you today about what is going on with stocks, okay? Because there's been a lot of volatility lately. I certainly have gotten calls from clients and different folks about just worries about the stock market right now and things like that. So let's get into it. Let's talk about it and go through this. So Greg, take it away.
Okay, yeah, great. Thank you. I mean, we usually like to start with a view of the S&P 500 and the trends in the market. And of course, we've been talking for months, almost really years now, since the recovery from the pandemic, about how we've been in this steady uptrend, very limited volatility, trading above all the major moving averages. Well, now here in the last month, that's changed a little bit. And we've broken through some key moving averages. We're kind of bouncing back and forth around the 200-day. So the way we're viewing this right now is the market has gone from a very clear, steady uptrend to really more of a neutral phase. And we don't think that's the end of the world. What we're seeing and that's causing a lot of this is the rotation. Certain areas of the market that had done well for a long time are weakening. Meanwhile, some other areas, value and so forth, have been improving. So we're still finding plenty of good quality opportunities out there, but the market as a whole is definitely seeing more volatility.
And one thing I want to add to that, Greg, is that we as investors tend to have short memories. And so yeah, from this low, okay, 2 years ago, right? So for the last 2 years, we've just had steady up. And so what we get conditioned into, well, the market just drives higher and it just pushes higher. And oh my gosh, wait, we just had a little downturn here. Oh no, we're gonna sell off. And what I would try to caution people and say, this type of move is not typical. This is the outlier here. And typically we do get drawdowns and things like that, and then build back up and drawdowns and build back up. So, it's almost like when I talk to clients and folks, I'm trying to help them just change their thinking a little bit. Like, we've been spoiled the last 2 years. Do not think the last 2 years are just going to extend out forever.
Exactly. Well, of course, one of the things we've been talking about a lot because it's been front and center in the market is interest rates. We've seen a surge here. This is the 10-year note. We've seen a surge in rates across the board over the last, several months, but really here just recently. And this is largely because the inflation numbers keep coming in hot. So the interest rates go higher. Now, we will say we're just back now to a level that we were at pre-pandemic. So the absolute level of rates that we're at is not necessarily a big deal. It's just more the rate of change, the speed that it's occurred, what people think it might mean for the market, and what the Fed is going to be doing.
Yeah, and I want to add to this too, and I know this is probably going to extend this video out a little longer than we do, but I just think this is really important because I do get a lot of calls. Oh my gosh, interest rates going higher, everything's going to go to the can, and we need to just get out of the market. Well, from 2013 to 2020, right, where the 10-year was between, I don't know, we'll call this maybe 2.5% to 3% to 1.5%, and between these areas, the market did very well. So just to Greg's point, a 2% 10-year is not a bad thing, right? It's this rate of change that the reason why a lot of, there's been a lot of just repositioning and things like that. But, it could keep going up. It could stay at this level. The market can still adjust over time to these levels. So that being said, let's talk a little bit about interest rates. This is a table of the Barclays Aggregate Total Return Bond Index. So it's a bond index. It's actually mostly of government bonds. Then it's got a lot of, like investment grade corporates and things like that in there. Well, if you go back to 1977, again, there's not a lot of down years. There's been a lot of down years in bonds. Now, I will say, majority of this time, interest rates have been declining. So, bonds tend to go up. But even still, during some very volatile periods, there just hasn't been that much. Well, last year, bonds were down a bit. And this year they're down, we've had a big move up. So they're down 4%. So what I want to say is that, yeah, we are worried about the rate of change as interest rates move higher, right? Bond prices go down. But also keep in mind, if you own bonds, right, these downturns are very minimal losses. So if you're in a bond portfolio, don't feel like, oh my gosh, I need to sell bonds because rates are going up. We're talking very muted losses here. really what bonds tend to do to a portfolio is they tend to reduce the volatility. And so that's one of the things that we're doing. They still are generating income. They're still kicking off income to you, but that the bond prices are being affected by the change in rates. So we are, this is something we've got on our radar. Now, granted, we're only a month and a half into the year, so a lot can still happen. But just to give you some historical perspective on what's going on. Okay, and again, this is a chart here of the Fed. A chart of the probability that the Fed is going to raise rates here in 2022 7 times. So meaning 7 25 basis point hikes, which would take us to a 1.75 Fed rate. Okay. That probability is coming in now over 90%, right? 93%. Now, again, a 1.75% Fed rate is still pretty darn low historically, right? That's not necessarily what is affecting things. It's the fact that, there's probably going to be some aggressive moves raising rates up. Okay. And that's what has the market a little bit unsettled right now. Okay. So the absolute term of the rate is still darn low, but we're probably going to see some moves this year, and it'll create some volatility in the market. And like I said, that is the norm when it comes to the market, not these just low volatility climb till kingdom come.
Yeah, just because the Fed is going to be raising rates, it doesn't necessarily mean the end of the cycle. I mean, this is some performance where we look at what has happened after the first rate hike historically. Yeah, in the short term, first few months or so, there can be some increased volatility. I think we're already seeing that ahead of time as the Fed will raise here shortly. But as you start to look out over 12 months, historically, the market has done quite well. Usually the Fed is raising rates because the economy is doing well. Now, we will say, if they raise as often as they're talking about, there's no question that increases some volatility and some risk. The market is factoring that in right now, wondering about, will the Fed be able to, stick the landing, so to speak. So it increases some risk, but it doesn't by any stretch mean the definite end of the cycle. Well, we've talked a lot about interest rates, but the other big topic going on in the world right now is what's going on with Russia and Ukraine. Just very briefly here, we did want to show this chart. We thought it was a great one, where we look at various geopolitical and military events going all the way back to the 1940s and what they mean for the market. There's been 12 notable instances here. Again, in the short term, there could be some volatility. They certainly can affect the market. I think that's been a factor here in the last month or so. But again, as you look out 12 months, historically, the returns have been solid. And only 3 times out of all these instances was the market down, and those all, not coincidentally, aligned with recessions economically. Now, of course, we can't, predict the future, but at the moment, it seems quite unlikely that a recession is in the near future. So if that's the case, chances are at some point, the market shrugs this off, just like it will eventually potentially shrug off the Fed. We showed a chart not too long ago about how in the midterm election year, sometimes those years have the bigger corrections, but they also have the biggest rallies off of those lows. So the market is forward looking, particularly as you get out to 6 to 12 months.
All right, so let's wrap this up and summarize here. We've had a last couple of years, we have this amazing uptrend in stocks. Now we're kind of in this neutral, volatile area. We talked about fixed income and bonds, and as rates have popped here, right, bond prices do the opposite, so it's hurt bonds a little bit. There are expectations, that the Fed's going to be increasing their rising, and just like you said, a risk for us, what we're concerned about is that the Fed is raising, and let's say inflation does start to slow the economy down, and things start to maybe slow down a little bit. Could we see a little bit of unhinging there, and they don't stick it right? So that is a risk that we just don't know at this point. Stocks do, though, historically do well after the first hike in rates. But again, it's going to probably bring us some volatility that we just haven't had to deal with recently. And finally, market trends tend to look past military events after short-term volatility. So, there is a lot going on in Ukraine. Look, there's always something in the news that's going to cause you concern about stocks. I don't care when, however, there will always be something, whether it's geopolitical, whether it's domestic political, whether it's whatever, there's always something in the news that will do that. I know one thing right now that I take some comfort in is every time that I go out, whether it's out to dinner, downtown here in Greenville, everything is packed. People are, traveling again. As COVID numbers come down, people are out, they're spending money, they're doing things. Our previous call last month, we talked about the consumer, we talked about them spending money. So there still is a lot of good things happening here in the economy. So just be careful and not let these headlines drown some of those things out. Okay. If you have any questions, give us a call. You know where to reach us. Thank you so much for watching today, and have a great day.